Hey everybody, it's John King, and here I am with your weekly market update. Here we are, June 7th, 2024, and we are launching this month with a lot of information that I want to dive in and share with you right away. So as I tell you every single week, let's talk about what is going on with interest rates. So we saw over the last week, interest rates actually came down between last week uh, and this week until this morning. So we saw a pretty good drop. We saw the 10-year Treasury go from about 4.5 to 4.3. And then this morning, it gets back up to about 4.4 to 4.45. Now, I don't talk a lot about the 10-year Treasury normally, but it is a good indicator of kind of where the markets are going. So what the heck happened this morning? This morning, we got the jobs report. And the jobs report is the first Friday of every month, most months, maybe the second Friday, depending upon timing, where they talk about how many jobs were created last month. Now, I was actually talking to some of my loan officers this morning, and I was describing why all of this matters, and I thought I'd share this analogy with you. So the Federal Reserve has two specific jobs. One job is to keep inflation low. The second job is to keep the number of people employed high. It's that simple. Those are their two jobs. Keep inflation low, keep the number of people employed high. Well, clearly the Federal Reserve's focus for the last 2 years has been keeping inflation low. And they do that by raising interest rates. So they affect monetary policy. When they raise interest rates, it makes people not want to spend money. It makes people want to pull back and say, hey, maybe I shouldn't go buy that car because interest rates are higher. And that typically brings down inflation, because inflation essentially is too many dollars chasing too few goods, meaning you got a lot of people wanting to buy not enough stuff that is available to be bought. So the Federal Reserve has been focused on that, but they're kind of like your doctor at the hospital who is saying, hey, we've got a patient that is in critical condition, and I've got to address the biggest issue we're dealing with right now. And sometimes the biggest issue is the one that's going to kill you the fastest. Good example might be, hey, you get into a car accident. When you're in that car accident, they shouldn't move you out of the car. Like, they should leave you there until the ambulance gets there and they can put you on the backboard and the whole thing. Unless the car's on fire and there's gasoline spewing everywhere and your life's in danger and they need to drag you out of the car immediately. So you sacrifice what is the right decision for the immediate need. The Federal Reserve has been doing the same thing. They've been saying, hey, the immediate need is inflation. So we're going to sacrifice the job market. It's been pretty strong anyway. But now that inflation is somewhat under control, it's like the patient who's now at the hospital. And the hospital is saying, look, we got to put this patient on pretty high amount of drugs. We've got to put a lot of medication into them so that they can overcome the issues that are happening with them. But the medication has side effects. In this case, the medication that the Federal Reserve has given us is raising interest rates. The side effect is businesses stop growing. Businesses say, you know what? I can't afford to hire more workers or to build that new plant or that new factory because it costs too much money. Interest rates have gone up too much. And so the Federal Reserve has to be that doctor that's keeping an eye on, hey, what's the main problem right now? Inflation. But what's the other problem? And once that other problem, so the doctor says, hey, by the way, Federal Reserve, the other problem is employment. How many people are working? And if too many people lose their jobs, we end up in a recession. So the Federal Reserve has to pay attention to both. What is this like in the doctor's situation, the medical situation? You've got the doctor that's looking at you saying, hey, right now we've got you on all this medication, but that medication could lead to more long-term effects. That medication could cause you to have liver problems in the near term. So I've got to watch your liver levels. And if there's some problems with your liver function, we've got to take you off of the medication, because you got to balance what you're attacking, what your main focus is. That's what the Fed has been doing. And that's what jobs represent. Jobs represent the Federal Reserve saying, hey, our primary problem has been inflation. But if jobs start crumbling, if fewer jobs are created, then we have a different problem. And we have to start lowering interest rates. So the amount of jobs that are created or lost is driving the Fed's decision of when to start lowering interest rates. And that's the key that you have to understand, is this all has to do with when are interest rates going to go down. They are going to go down. The Fed cannot keep us on this high amount of antibiotics forever, but they're going to keep us on it for a long enough amount of time, maybe a little bit too long of amount of time, as long as they're not impacting us over here, as long as our liver function is still working just fine. So how does this play out to what happened this morning? We had a very strong jobs number. The last couple of months, we've seen a little bit of weakness in jobs, which says, oh, wait a second, the Fed might take us off those antibiotics, might start lowering interest rates because the jobs market is getting weaker. And the problem is today's report showed a really strong number of jobs created, but the unemployment rate went up. How the heck does that happen? The unemployment rate is the percentage of people who want to work that cannot find a job. We went from 3.8 or 3.9% to 4% of the population that wants a job cannot get one. How is it that we created more jobs than anybody expected, yet the unemployment rate went up? First of all, because the numbers are a bit skewed. Secondly, technically, it just means more people entered the workforce. More people said, you know what? I want to start looking for work. So that number of people entering the workforce that could not find work causes the unemployment rate to tick up. That's a bad sign for the job side of things. So this says, hey, we might start seeing interest rates coming down if the unemployment rate keeps ticking up. So there's a little bit of mixed results this morning, but it caused interest rates to go up today. So that jobs report happens once a month. It is probably the most important report right now because the next two reports that come out are inflation reports. Next week and the week after, we'll get an update on how are we doing on inflation. But here's the deal, continuing my analogy I've been talking about here, the Federal Reserve has us on really high antibiotics for inflation. They've got us on a really high interest rate that is fighting the inflation. If the inflation ticks up a little bit, they already know they have super high antibiotics being pumped into our IV. So are they really going to freak out? No, it's all about the other side. It's all about the jobs, which if we lose jobs, it creates a recession. The Federal Reserve wants a soft landing. They want to bring inflation down without causing job loss to skyrocket and cause a recession. So hopefully that makes sense. I got a lot of people asking questions. I've got a lot of other topics to cover, but let's really quickly pull up what my questions are. So Billy says, nice analogy. Thank you very much. Appreciate that, Billy. And Palak says, any Dream for All updates? As a matter of fact, yes. So let's dive right into the Dream for All updates. So here are the updates on Dream for All. Let me switch one more thing here, which is this little floater thing above my head right there. Okay. So Dream for All updates, 3 things you need to know. CalHAF has sent out, doesn't it suck? By the way, I turned 49 yesterday, so I guess that makes me almost an old man, and now I got to wear my readers more often. Anyway, doesn't it suck that you have to wear those? Okay, so Dream for All, CalHAF has sent out an email yesterday. I don't know if it was public, but they basically, I think they were talking just to the loan officers, and they said a few things. They said, first of all, tell your buyers, plan for the end of June. So they had said the middle of June. Now they're saying plan for the end of June. I have been telling you guys for the last few weeks that they projected, hey, mid to late June. Now they're telling you plan for the end of June. The second thing, they actually warned us there's been a lot of scam attempts against people who have, I don't know how they know who's shown interest in Dream for All, but scammers have been sending out emails telling you to log in and register because there's something wrong with your Dream for All application. Do not click a link to log in. Go directly to CalHAFA's website and log in that way because scammers are capturing people's information. They are stealing information because they're telling you, hey, please re-verify. Give us your social security number. Give us your whatever so that we can confirm your place in line for the lottery. They're smart people. These scammers make money because they understand how to take advantage of your fear. So if you get, first of all, my understanding is CalHAFA is not auditing anything right now as far as asking for anything from you. But if you do get an email and you think it's legitimate, go to calhafa.ca.gov. So Google CalHAFA, then click on Dream for All, then click on go into the portal, go into the portal directly, log in and look at your tasks. See if something is required on your tasks. Because if it's not, it might have been a scam email. So be very, very careful of that. Again, they told us to warn everybody about that piece. The final piece on Dream for All is income limits. So I did a 10-minute video yesterday that I released going into detail about the income limits. If you want to get the numbers, scan this QR code up above, or it's in the description down below. But the income limits changed. CalHAFA adopted the new income limits for 2024. I've been talking about this since the beginning when this all came out. And I said, every year in June, July-ish, the income limits are updated. I wonder if they're going to change the income limits. Then last month, we got the income limits from Fannie Mae and Freddie Mac. In some counties in the state of California, the income limit went down. The area median income, not the limit, the area median income dropped in those counties. Now, I have really good news. You can watch the video. It's in my library, or you can scan the QR code and see the details. The fact is, CalHFA did not lower the income limit anywhere in the state for Dream for All. They either kept it the same or went up. So if you're on the bubble and you said, man, I'm a little worried that I'm projected to make a little bit above, you may have good news, because in some counties, the income limit went up by as much as $19,000. So we saw a pretty significant increase in the income limits for a lot of counties, a handful of counties, I should say. A few counties went up only by 1,000. A few counties went nowhere, just stayed exactly where they were. One of the big ones everybody's asking about is Los Angeles County, no change. Remember, 25% of the money is going to Los Angeles County. Los Angeles County was $155,000 originally. It's still at $155,000. So there's zero change. All right, last thing I want to talk about, $50,000 grant. A $50,000 grant. There is going to be a video. I just finished recording it, but it's not going to be live, so it'll be published later on today. But there's going to be a video that is going to talk about this brand new $50,000 grant program. I don't have a date on when it's going to be launched. It is going to be first come, first serve. You have to have $10,000 of your own money or gift money for down payment. Then the grant program will give you $50,000 to go with that. So you'll have $60,000 to put towards down payment and closing costs. You do have to be a first-time home buyer. There are income limits, but it's realistic income limits. It's instead of being super low, it's middle income. So it's between 80 and 140% of the area median income. That may not mean a whole lot to you, but I've got a link. Scan this QR code right here. You can see all of the details. There's also a link down below in the description that gives you all of the details on a landing page that I created that tells you all about it. The money is going to go pretty quickly. It's not going to be easy to get, but guess what? Things that are worth it in life, they're not easy to come by. So this is going to be one of those programs that we're going to have to be nimble. We're going to have to work together. We're going to try and get the money, but it's going to go quickly. I'll tell you that there's no lottery involved. It is first come, first serve. And we've got to find other institutions that are managing this grant program. There's $20 million of funds of $50,000 a piece. Okay, so we're talking about 400 people between California, Nevada, and Arizona that are going to get this grant. They offered it last year on a pilot program, and it went very quickly. There was half of the amount of money. This comes from the federal government through the Federal Home Loan Bank system. So check out this QR code above or click the link down below to get more information about it. I don't know a whole lot. I gave you as much as I possibly can in that video. What you need to do is register. If it's something that you think you would be eligible for, then fill out your information on my page so that we can keep you updated and figure out if this program is going to work for you. And if it doesn't, then we'll find something else that does. All right. So Q&A. I've got probably 30 people on here right now. So let's see. So Paul asks, Palak, excuse me. Is the grant 100% forgivable? I don't have all the details. Because they called it a grant, yes, the answer is it's going to be forgivable. But this is from the same government entity that's providing the WISH program. And WISH money, you have a timeline you have to keep the home. So you have to keep it for at least 3 years in order to have the money forgiven. My best guess is it's going to have the same timeline requirement. The details are still coming out. The federal bank only released the press release on it 3 days ago. So 4 days ago, it came out on June 3rd. So this is new information I'm giving to you as quickly as I possibly can. I don't have all of the details. I've got some webinars coming up over the next 2 weeks to give us more information about it. And I will pass it along as soon as I get it. So I appreciate that, Felix. Anybody have any other questions, feel free to ask them right now. Otherwise, check out the information. Please share my channel. So if you have somebody that you think could use this information, I would love the opportunity to connect with them. If you could share this with everybody that you know to help them be in the know about home ownership, I would really appreciate it. All right, guys, doesn't look like there's any other questions. Hope everybody has an absolutely wonderful Friday, and we'll talk to you all soon. Bye-bye.